with Asset TV, and I'm joined today by Phil DeSantis, CFA, Head of Product Management, and Harvey Steele, Head of Intermediary Distribution from Westwood Holdings Group. Their firm has just launched a new Sensible Fees model. Today I want to dive in and uncover what they're up to, since fees and pricing seem to be perennial topics in the finance industry. Gentlemen, so great to have you here today.
Thanks for having us.
Great to be here with you.
Well, Harvey, Phil, I read about your program, and it does make some very bold headlines and statements. Now, I read that it is meant to disrupt the asset management industry and that it is revolutionary. So can you tell me a little bit about what's underway at Westwood?
Sure. Remy, the last 10 years, active managers have struggled, and investors have been disappointed with performance. Fees are front and center in that problem and in that equation. And what we want to do is we want to change the conversation. We want to help change that formula for investors. And another part of the problem is that regardless of outperformance or underperformance, investors are paying high fixed fees. So in changing that conversation, we developed Sensible Fees. And at Westwood, the goal was to create a very innovative, simple solution that's designed to do three things. One, solve the fee problem. Two, change the probability of winning for investors. And that's around giving investors a better statistical advantage to outperforming. And three, leveling the playing field for investors where there's better alignment, meaning investors only should pay for outperformance, particularly in efficient asset classes where it's very difficult to outperform.
And Phil, you set the ground for this conversation, and the great thing is we have this opportunity to discuss what's happening at Westwood. So Phil, can you tell me more about Westwood Sensible Fees?
Sure. Sensible Fees are offered in two structures today. One is what we call Sensible Zero-Based Fee. It's a very straightforward structure. It's a flat base fee of zero. The investor would only pay when we outperform, and they always have the asymmetric advantage, meaning they retain 60 to 80% of the level of outperformance. We're using alpha as a measure for that level of outperformance. Two is what we call sensible IR fees. And this is really what we believe is a game changer. We think it's an industry first. We're taking information ratio, which has been used by industry experts and academics for a very long time, and we're converting it to a fee. And what information ratio does is it measures not only the level of outperformance versus the benchmark, it measures the level of risk management. And what we're trying to do is we're trying to quantify risk management and quantify active risk. A lot of managers talk about risk management. We're actually quantifying it and converting it to a fee. So we think that is the most ideal alignment for investors that are looking at not only the level of outperformance, but risk-adjusted performance.
And that naturally brings me to my next question. Is this going to be offered in all of your strategies?
So we started with LargeCap, particularly our select strategy, for a few reasons. First, the largest problem from the fee symmetry standpoint is LargeCap equities. If you look at LargeCap equities here in the United States, call it 3 out of 4 managers underperform over the long term. And the quarter that does have outperformance typically will charge somewhere between 60 and 70% of that outperformance in a fixed standard fee. So if you think about really what can change the potential outcome for a client, it's addressing fees in that space. There are other asset classes we will look at. I think there's some other asset classes with problems, but there's other asset classes that we think are just fine. If you look at small cap, for example, roughly 3/4 of small cap managers do outperform. And when they do, they outperform by a fairly wide margin. So although lower fees are better than higher fees, it isn't really the fundamental issue that's causing somebody to miss a retirement goal or miss a retirement savings or something along those lines.
And I do want to get the perspective of how an advisor can use these zero-based fees in an attempt to change probability for clients. How does this alter a client's asset allocation decision versus shifting passive?
Sure. Well, I think you have to examine the real cost of passive. You know, over the last 10 years or so, we've been in a largely beta-driven rally, so the market's done incredibly well. If you're a U.S. equity investor, call it mid to high teens performance. If you have an ETF with a very low fee, a financial advisor on top of that, you're still delivering exceptional value for a client, and clients are going to be very happy. I think capital markets expectations have changed quite a bit, and depending on who you read, we're talking, call it 4 to 6% over the next decade or so with increased volatility. So if you're starting at a baseline of, call it 5%, with full market volatility and then a financial advisory fee, it just gets really hard for a client to identify with a portfolio that doesn't have a specific intent. So I think active managers could layer in things like lower volatility, you have a chance for alpha. all of which financial advisors and their end clients are going to need in the next decade moving forward. So I think that's really the cost of passive that you have today.
So while we're on the topic of fees, I want to ask about the rationale for using these risk-based fees and also the inspiration for sensible fees.
It's a great question, Remy. The inspiration was, one, performance fees have been used by many investors for a long time. And it's what they typically call fulcrum fees. But the traditional challenge with fulcrum fees is, one, the base fees are too high, and two, the active manager can still swing for the fences, and there's still a level of misalignment with the investor. So the inspiration for sensible fees was, one, let's solve the problem. Base fees are zero or a low ETF-like fee, and two, we're using a risk-based approach to create better alignment with the investor. So fundamentally, that was the underlying thesis and inspiration for sensible fees.
And that is a healthy sum you just mentioned there. And when it comes to statistics, Westwood has been an active manager for 35 years.
Correct.
So tell me about the timing of this and why you chose this moment in history.
Well, we believe we have a unique advantage where we're not only active managers, we've been active managers for 35 years, but we're what we consider high active share managers. When we look at the two most important corollaries to outperforming, particularly in an efficient asset class, it's active share and its fee structure. Well, we've been managing high active share products for a very long time. Our LargeCap Select product, which we're bringing to market, has a 5-year track record, has an active share level of roughly 87% as of the end of December. The key to that was really combining that with a sensible fee structure, again, to give the client more of an asymmetric advantage, to attempting to give them a better probability of outperforming, changing the math, and then aligning with the investor where we have shared risks and shared objectives. If you think about our industry today, we're one of the few industries that you're paying for something regardless of what the outcome is. We want to completely turn that model on its head here.
And we know both retail investors as well as advisors are paying attention to fees. So my question is about fee compression, and that has been an issue, but what are some other trends that you also want both advisors and retail investors to be aware of right now?
You know, I think one thing on fees is not just an absolute level of fees, but it's an alignment with how you get to your fee. You know, traditionally in the active space, there's been two ways to charge a client a fee. One is a fixed fee, and we've obviously seen some pressure there. They were very high here historically. The other is a traditional incentive fee or a fulcrum fee. The issue with both of those is you don't really have an alignment in incentive between the asset manager and the asset owner. So if you have a fixed fee bucket, you're incented as the manager to put as much money in that bucket as humanly possible, raise your aggregate level of fees. If you're looking at a performance fee, traditionally, they haven't been risk-based, so they've been based on excess return. And we all know markets go up most of the time, 7 or 8 out of 10 years. So theoretically, you could be incented to just put more risk in a portfolio, kind of swing for the fences, if you will. And if you're right, you have a higher level of fee for a client. What we really tried to do is embrace the alignment issue. So what we're looking for is we're not paid in aggregate on AUM in that we don't have a base fee. And then our fees are calculated based on risk-adjusted return. So it's really how much we do for a client above a benchmark given per unit of risk. So we're disincented to kind of break with that alignment and really look out for the asset owner.
Harvey, Phil, we're here in the beginning of the second quarter, and so far a lot of interesting things have happened in terms of geopolitics as well as fundamentals, and we'll all keep an eye on that. But as we head into the rest of this year, what is the bigger vision for you?
The bigger vision for us right now is we want to educate investors on sensible fees. I mean, we believe as we look forward with active management and creating new alignment with investors, we see this as the new paradigm. We're starting with large cap. We want to solve a problem in an efficient asset class that, as Harvey mentioned, is one of the biggest and one of the most important asset classes in investors' portfolios. And we think we're solving a problem with risk-based fees that address the typical criticism with fulcrum fees, that the base fees are too high and they're not risk-based. So as we look forward, it's educating investors. And I would say we have certainly bigger ambitions with sensible fees. We're not going to put all of our cards on the table right now, but certainly ample opportunity to help investors solve the fee problem and change the math for investors.
And Harvey, do you have any insight into what he just said, and do you have a bigger vision as well?
Sure, I think we're looking at multiple structures. Obviously we're starting with the separately managed accounts standpoint. It's a little bit more elegant of a solution from a tax standpoint. It's also a little bit less expensive for investors, so we're starting there. But would love to look at multiple different structures.
Well, it's that time of year when people are paying attention to their personal taxes. So thank you for that tidbit as well. Okay, gentlemen, well, thank you so much for joining me here in the studios in Newark, and thanks for all your insight.
Thank you.
Thank you for having us with you.
And thank you for watching. This is Asset TV.